Imagine a path to, well, real financial independence.
Yeah.
Where your decisions directly shape your future. No boss, no 9-to-5 grind. Sounds pretty great, doesn't it?
It really does. But Dr. Alexander Elder, who's both a trader and a psychiatrist, interesting combo there, he points out in his book, Come Into My Trading Room, that this path, it's often full of hidden traps.
Right. Pitfalls most people don't see coming. And many who start out, well, they just don't make it. So today we're doing a deep dive into this fascinating, often kind of misunderstood world, trading.
Yeah, our mission today is really to cut through all hype, all the noise, and give you a shortcut to understanding what really matters for successful trading. We're digging into Dr. Elder's key ideas from his book, which came out back in 2002. But honestly, the principles are timeless.
Exactly. This isn't about hot stock tips or predicting next week's market moves. Forget that.
No, it's about the psychology, the analysis, the risk management, the core truths that separate the consistent winners from, well, everyone else.
So whether you're just curious about trading, maybe trying to get up to speed on the field, or even, prepping for a meeting where you need to sound like you know your stuff.
Yeah, happens.
You'll definitely walk away with some solid insights. And probably a few surprising facts, too. Because ultimately, as we'll see, trading success really hangs on three critical things: mind, method, and money.
The 3 M's. Simple but profound.
Okay, so we touched on that allure, that dream of freedom trading seems to offer. But Dr. Elder throws up a flag pretty early on. He says you need to figure out where you really stand when you approach the market. He talks about 3 distinct paths, like walking into a big forest, path 1, the sunniest path. This is for intelligent investors, people who profit from long-term trends, holding things for years sometimes.
Right, like the examples he gives buying KinderCare way back because more women were working, or MCI when the AT&T monopoly broke up, or even getting Dell stock for like $3 a share and just holding on.
Patient capital, long view. Then there's the path for intelligent traders. This goes deeper into the heart of the forest, as he puts it.
These are the folks navigating shorter-term moves, right? Looking to profit from swings over maybe weeks, days, sometimes even faster.
Exactly. And then path 3, the shortcut to the swamp.
Mm-hmm.
That's for gamblers.
And that's where most beginners accidentally end up, isn't it? Without even realizing it.
Yeah, and the danger is that gambler path often crosses the other two. It can really blur the lines if you're not careful. You got to know which path you're actually on.
You know, what's fascinating about this is how it kind of pushes back against that academic idea, the efficient market theory.
Oh, yeah, the idea that prices reflect everything already, so you can't possibly beat the market consistently.
Right, like playing chess against someone who knows all your moves in advance. Academics love that theory.
But the reality on the ground, it's different. Because you've got human emotion messing things up. Fear, greed, those sweaty palms Dr. Elder talks about.
Exactly. And those emotions create inefficiencies. Panic selling, chasing rallies, that's where the disciplined trader finds their edge. The crowd often acts irrationally.
It's such a key insight, really. Understanding crowd psychology, understanding your own psychology, that's powerful stuff, not just in markets, but anywhere. The decisions are made by groups.
Absolutely. And it makes you rethink what price even means. It's not some fixed objective thing.
Right. Dr. Elder says each price you see is just a momentary agreement, a consensus of value among everyone participating right then.
He uses that great analogy of a mile-long rubber band connecting prices to underlying value. Prices can stretch way above or below, but they're always sort of linked.
So prices and indicators are really just reflecting shifts in crowd psychology.
Right.
Interesting.
Yeah, so if emotion drives inefficiency, where do the gamblers fit in?
Well, he makes a really important distinction. A professional gambler, think a poker pro. They calculate odds. They only bet when the math favors them. It's cold, calculated, a job.
Whereas the losing gambler, they're just looking for the buzz, the action.
Exactly. And he even gives this super practical rule for recreational gambling. Put your risk money in one pocket, winnings in another. Once the risk pocket's empty, you stop, period. Don't touch the winnings.
Simple but powerful self-discipline. It really highlights the difference between calculated risk and just chasing excitement.
And again, that insight applies way beyond casinos or markets, right? Understanding crowd behavior, controlling impulsive decisions, it's everywhere.
Totally. Okay, so before you even dream about winning, Dr. Elder says, hold on. You've got these external hurdles to clear first. Big ones.
Yeah, that lure of freedom, working anywhere, being your own boss, it's strong. Very appealing.
But then come the hidden costs. The things beginners often ignore, and that, frankly, take a lot of them out of the game, like transaction costs.
Ah, the guinea pig factory analogy. I love that one.
Yeah, you buy a guinea pig for $4, sell it for $6, think you made $2. Nope. A big chunk goes to the factory, the broker, the exchange.
And the math he lays out is stark. A $20 commission might seem small, but on a $20,000 account, it's 0.1%. Do a round-trip trade once a week.
And boom, 12% of your equity is gone by year-end, just in commissions.
But take that same $20 commission on a small $2,000 account. That's 1% per trade.
2% for a round trip. Trade once a week, and your annual commission cost could be over 100%. You're wiped out before you even start making good decisions.
It makes you realize why the pros, like Soros, who made incredible returns, just couldn't operate with those kinds of costs. Account size really matters for commission impact.
Then there's slippage, another hidden cost.
Right, the difference between the price you wanted and the price you got. You try to buy at $4, it fills at $4.25. Sell at $6, get $5.75.
And the pros, they kind of feed on that. Anxious buyers pay the ask the higher price. Fearful sellers hit the bid the lower price.
Patience helps here, right? Using limit orders to set your price instead of market orders, which just guarantee a fill but maybe at a bad price.
Exactly. And the kicker, slippage can often cost you more than commissions, especially in fast-moving markets.
Wow, okay, what else? Software, data feeds.
Yep, more costs. He tells this story about a trader super excited about this fancy $1,000 a month software package.
Sounds powerful.
Sure, but the trader only had a $50,000 account. That software cost alone was nearly half his capital over a year. Just wasn't proportionate.
Got to keep costs in line with your account size. Makes sense. And then there are the gurus.
Ugh, yeah. Some advisors thrive on making things seem complicated, keeping you dependent. Honest experts. They simplify. They empower you to decide.
So the big takeaway here is you have to face these external costs head on, realistically, before you even think about strategy.
Absolutely. And it's okay to look at all this and decide, you know what, trading isn't for me. Better to decide that early based on facts than after getting burned.
Okay, powerful stuff. Let's move into the first M mind, the psychology. Dr. Elder doesn't pull punches here. Most people who try trading fail.
Yeah, it's a tough reality. And interestingly, it says a lot of the money amateurs lose doesn't even go to the winning traders. A huge chunk just gets eaten up by the industry itself.
Commissions, slippage, software, those external barriers we just talked about.
Exactly. For many, the market provides, as he puts it, fantastic entertainment value. But that entertainment is incredibly expensive.
It's a trap. So what separates the pros? They know their edge.
Right. Every single pro knows why they should make money, what specific advantage they have. Amateurs, often clueless.
It reminds me of that Warren Buffett poker analogy.
Yeah.
If you sit down and can't spot the sucker, the pigeon, within 15 minutes.
It's you, yeah. He tells this story about a friend in Boston who lost his house trading gold. Just didn't have an edge, didn't understand why he should win.
Ouch. Now this next bit is crucial, the psychology of excitement.
Oh yeah, the rush. Seeing your stock jump, quickly calculating paper profits, it feels alive, intense.
But here's the core contradiction Elder points out. You cannot feel excited and make money at the same time.
It's so true. Think about professional card counters. Are they jumping up and down? No. They're cold, patient, executing their mathematical edge. It's work.
That emotional detachment is key. Because those calm plans you make over the weekend.
Tripped up. Come Monday morning, the sweaty palms take over. People start making emotional decisions.
And those little phrases are red flags, right?
Yeah.
This time is different. It's just an exception.
Classic emotional trading talk. He mentions a university professor, brilliant guy, PhD, saved $1 million, but got emotional, followed his broker's bad advice.
Wiped out his life savings. Tragic.
It really underscores the need for total responsibility. You make the trade, you own the outcome, separate the emotion.
Which leads to planning your exits. So important.
Critically important. Elder argues the best time to decide when to get out is before you even get in, when no money is actually at risk.
Because once you're in, emotions cloud your judgment. And that common mistake, turning a losing trade into a long-term investment.
Oh, the hope and pray strategy. Yeah, it's a common disease, he calls it. The painful truth is the first loss is the best loss. Cut it quickly.
This also gets into some deeper psychological territory like self-destructiveness.
Right. The idea that sometimes, maybe unconsciously, people sabotage their own success. Like they fear the freedom it might bring.
He tells that story about the truck driver. Saved for years, bought a brand new truck, uninsured.
And totaled it the very first day. Was it just bad luck? Or maybe an unconscious pullback towards the safety of a regular job? Makes you think, doesn't it?
It really does. And this is where his psychiatric background brings this really unique perspective. The parallel between losing traders and recovering alcoholics.
Yeah, this is fascinating. He attended an Alcoholics Anonymous meeting and had this light bulb moment, just replace the word alcohol with loss.
People's lives controlled by drink. A trader's life driven by losses. The cycle of trying to win back what you lost.
And the first step to recovery in AA is admitting you're powerless over alcohol. For a trader, admitting the market is stronger than you are. You can't control it. You can only control your response.
He even wished for a Losers Anonymous, or LA group. But he figured it wouldn't work. Too much competition, envy, showing off.
Yeah, the trading world isn't exactly known for supportive group therapy, but the analogy is powerful for self-reflection.
Definitely. He sees the market itself almost like a collective mind, a malignant mass mind.
That seeks out your weaknesses.
Exactly. It finds your psychological weak spots, fear, greed, impatience, and exploits them. So successful traders have to conquer those inner demons first. Stay balanced, detached.
So ultimately, the goal is accumulating equity, building your capital. And that boils down to 2 questions for every trade.
Just 2. What's my profit target, and how will I protect my capital? Everything flows from that.
And how do you build that discipline? Records, meticulous records.
Yeah, he contrasts trading with professions like pilots or doctors. They have mandatory training, oversight. Traders, we have to create our own structure.
And the core of that structure is keeping records, a detailed spreadsheet tracking your equity curve, and a trading diary. He calls the diary the single best learning tool.
It's your feedback loop, your mirror. It forces honesty about what worked, what didn't, and why. Helps you learn from wins and losses without ego getting in the way.
Okay, that's a deep dive into mind. Let's move to the second M method. Technical analysis, trading systems, the how-to part, right?
Right. Technical analysis is basically studying charts, looking for patterns that tend to repeat, identifying trends, getting buy or sell signals. It's become way more accessible with personal computers, obviously.
But again, he emphasizes there's no magic bullet, no secret password here.
Yeah, it's work and a bit of flair. Smart traders look at fundamentals, sure, but they spend most analytical time on technicals because it helps read the market psychology in action.
And the tools. Keep it simple. Don't get bogged down in complexity. Choose a few markets. Pick a handful of indicators you really understand.
5 bullets to a clip, as he says. Learn to use a few tools really, really well. Simplicity and discipline go hand in hand.
Makes sense. So let's touch on a few core concepts, like trend lines.
Simple, but powerful. You draw them across the bottoms of price swings in an uptrend or across the tops in a downtrend. Gives you a visual guide to the main direction.
And he mentions kangaroo tails. What are those?
Yeah. Imagine a really tall price bar, a strong move. But the very next bar is tiny, narrow, like all the momentum just vanished.
Okay.
That sudden lack of follow-through, that tail sticking out, often signals the trend is exhausted. Potential reversal point.
Interesting visual. What about support and resistance?
Key psychological levels. Places where traders tend to make decisions, buy at support, sell at resistance.
And often, an old support level, once broken, becomes new resistance on the way back up.
Exactly. Because all the people who bought there and are now losing money are just waiting to sell and get out even if price comes back.
Yeah.
Creates a psychological barrier.
Got it. And false breakouts. Sounds tricky.
They are. He says most breakouts are actually traps. Fishing expeditions by pros to trigger the stops of amateurs.
So they push price just above resistance, suck people in, and let it fall back.
Pretty much. The S&P futures are notorious for it, he says. The real opportunity often comes after the false breakout, when price fails and comes back into the range.
Good to know. Now, indicators. You mentioned keeping it simple. He prefers a toolbox over a black box.
Definitely. Black boxes are those automated systems sold with amazing back-tested results.
But they're curve-fitted to old data, right? They tend to blow up when market conditions change.
Exactly. A toolbox approach means you understand the tools, maybe a few moving averages, an oscillator, and you make decisions. It empowers the trader.
And a core method he advocates is the triple screen system. What's the idea there?
It's about looking at the market through multiple time frames. At least 2, maybe 3.
Okay, why?
To align your short-term tactics with the longer-term strategy, use a longer chart, say weekly, to decide the main direction, buy, sell, or stay out. That's your strategic decision.
Like checking the tide before you decide where to fish.
Good analogy. Then use a shorter chart, maybe daily, for the specific entry and exit points, your tactics.
So for a day trader, maybe a 25-minute chart for strategy and a 5-minute for tactics.
Could be. He even mentions using uncommon parameters like 25-minute charts can sometimes give an edge. The key is combining different time perspectives and combining trend-following tools with oscillators.
Let's quickly touch on a couple of those tools he highlights. Moving averages.
Classic. Simple MAs, smooth out prices, help you see the underlying trend, find areas to potentially buy dips in an uptrend or sell rallies in a downtrend. Very versatile.
And the MACD histogram. Sounds more complex.
It measures momentum, basically.
Yeah.
How fast price is changing. It shows the difference between two moving averages.
And its main use.
Divergences. When price makes a new high, but the MACD histogram makes a lower high, that's a warning sign. Momentum is fading. Potential reversal brewing. Super useful on daily charts especially.
Okay. Now, testing a system. He's not a fan of just relying on software backtesting.
No, he thinks it gives a false sense of security. Too easy to curve fit. He advocates for manual, one bar at a time, forward testing.
Seems tedious.
It is, but he argues it's essential for building real decision-making skill and confidence in your system. You live through the signals one step at a time.
What about paper trading? Practicing without real money?
Useful for learning the mechanics, definitely. But he warns it doesn't prepare you for the emotional pressure of real money being on the line.
So better to start small, with real money, but tiny amounts.
That's his advice. Engage the emotions, learn to handle them, but keep the risk minimal initially. Ultimately, you adapt a system, tweak it, make it yours. That ownership builds the confidence you need for discipline.
Makes sense. Which brings us perfectly to the third M money. Risk management, capital allocation.
And Dr. Elder is crystal clear. This is the ultimate key to success. Survival first, always. Then steady gains. Then maybe spectacular results down the line.
And math is non-negotiable.
If you cannot count, you cannot trade. Simple as that. Basic math, percentages, probability. You got to understand the numbers.
And understanding the difference between a normal businessman's risk, small equity dips, and a true loss that threatens your ability to keep trading.
Yeah, never cross that line into a potentially fatal loss, which leads to the cornerstone rule.
The 2% rule.
Bingo. Never, ever risk more than 2% of your total trading capital on any single trade. This rule dictates how large a position you can take based on where your stop loss is.
It's your shield, protects you from that one catastrophic mistake.
And then there's the piranha protection, he calls it.
The 6% rule. Right. If your total losses for the month hit 6% of your starting equity.
You stop. Shut it down. Close all positions. Take the rest of the month off from trading.
Why is that so important?
It stops a bad run from spiraling out of control. Prevents revenge trading.
Yeah.
Forces you to take a break, reassess when things aren't working. It ensures survival during inevitable losing streaks.
It's like built-in circuit breakers for your emotions and your capital.
Exactly. Think of your capital like a scuba diver's air tank. His octopus rig has multiple regulators for safety. Capital is your air. Don't run out. If you don't find treasure today, you can dive again tomorrow if you still have air.
Love that analogy. And the monkey trap.
Yeah, the monkey reaches into a jar with a narrow neck, grabs the bait. But now its hand is a fist and won't fit back out.
And it won't let go of the bait, so it gets caught.
Exactly. Illustrates greed or ego, refusing to take a small loss because you want to be right. That refusal can trap you in a much bigger loss. Let go of the bait.
So how should you increase your trading size if you are doing well?
Slowly. Very slowly. Start small, maybe 100 share lots. Only increase your size after a period of consistent profits. Say, 2 profitable weeks for a day trader, maybe 2 months for a swing trader.
And if you hit a losing streak?
Retreat fast. Cut your size back down immediately. Advance slowly. Retreat fast. Always catch your risk before you start dreaming about profits.
It's interesting why institutional traders often seem to do better than private ones, even if the private trader is smart and educated.
Yeah, the private trader often washes out quickly. The institutional guys, maybe less background sometimes, but they last longer. Why?
Oversight. Discipline imposed from above. Their firms have strict rules, especially on maximum monthly losses or drawdowns.
That external discipline is key. He notes many successful institutional traders fail when they go independent because they lose that structure.
So the lesson for private traders is you have to create your own rigorous oversight. Be your own tough manager.
Absolutely. And on exits, place your stop loss immediately after entering. No hesitation.
And only move it in the direction of the trade to lock in profit or reduce risk. Never move it further away to give a losing trade more room.
That's pure emotional discipline right there. resisting the urge to hope.
He also introduces some smarter stop-loss techniques, like the safe zone stop.
Right. This tries to place stops away from the obvious levels where pros might hunt for them. It uses market volatility, the recent noise, to calculate a safer distance.
Requires a bit of calculation, maybe a spreadsheet.
Yeah, you measure the recent price fluctuations to find the typical noise level and place your stop just beyond that. Keeps you away from the crowd stops.
And for profiting from trends, this chandelier exit.
This is a trailing stop. It hangs down from the highest point the price reached during the trade, like a chandelier from a ceiling.
And it moves up as the price moves up.
Exactly, but it adjusts based on volatility too, so it keeps a sensible distance. The idea is to let profits run, capture a good chunk of the trend, but have an intelligent mechanism to get you out when it turns, not trying to pick the exact top.
Smart. Okay, so we've covered mind, method, money. The final piece is putting it all together, becoming the organized trader.
And again, it comes back to discipline, which, he argues, is measured by your records. Meticulous record keeping isn't optional, it's essential.
Starting with the trader spreadsheet, what goes in there?
Everything. Entry, exit, commissions, slippage, profit loss. But also a crucial trade grade.
A grade, like A, B, C.
Yep. Based on how much of the potential move, like the channel width, you actually captured. An A might be capturing 30% or more. A C maybe 10–20%. It's an objective measure of your execution skill, not just the outcome.
Helps you see if you're cutting winners short or letting losers run too long relative to the opportunity.
Exactly. Then there's the equity curve.
Plotting your account balance over time, usually monthly. You want to see it rising smoothly with only shallow dips or drawdowns.
And here's a key insight. When should you add more capital to your trading account?
Only when your equity curve pulls back slightly to a rising moving average of itself. Treat your own performance like a stock by the dips in an uptrend. Don't add money when your performance is tanking.
Brilliant. And finally, the trading diary. He calls this the single best learning tool.
This is where you record not just the trade details, but the charts, your reasons, and critically, your feelings during the trade.
Right. Were you calm, anxious, greedy? It forces self-reflection, helps you learn from mistakes without beating yourself up or getting cocky. It connects the mind and method.
Okay, time management is also part of being organized. Trading offers freedom, but
freedom can be scary. Some people, he suggests, almost prefer the security of corporate cages and that earn and spend cycle. It's a neurosis almost.
Interesting psychological point. He brings in Joe Dominguez's your money or your life philosophy here.
Yeah, the idea of conscious spending. Realizing how little you might actually need to be comfortable. That frees up mental energy for rational decision-making instead of chasing money out of fear.
And trading takes time. It's not a get-rich-quick scheme.
No way. He calls it an old man's game. Patience, gradual improvement. He estimates maybe 2 hours to research a new market properly, then maybe 15 minutes per position for daily maintenance. It adds up.
It's a serious commitment, which leads to the need for a written trading plan.
The hallmark of a pro. Not a rigid robot system, but a flexible framework. It outlines your rules, especially for money management and using multiple time frames, but still allows for judgment. It's your business plan for trading.
And traders evolve, right? He outlines stages?
Yep. First, the beginner, all focused on finding the magic method, totally unaware of risk.
Then the intermediate, or semi-professional. They get the methods, but profits are inconsistent. Lots of insecurity. This, he says, is where you fight the biggest battle.
The person he sees in the mirror. Overcoming your own psychological flaws. That's the big hurdle.
And finally, the professional. Calm, disciplined, laser-focused on risk and money management. Emotionally resilient.
And he gives performance benchmarks.
Mm-hmm.
Beginners aim to cover costs, maybe beat T-bills. Semi-pros shoot for maybe 20% annual return. Pros, maybe 25% a year, but with small drawdowns, like under 10%.
Those drawdowns are key. It's about consistency and capital preservation.
Absolutely. And if you're good but undercapitalized.
There's the option, once you prove consistent profitability, to trade other people's money, manage funds, leverage your skill. He shares stories of traders who started small and built fortunes that way.
Proof that mastery can open doors. Okay, so let's wrap this up. We've dug deep into the 3 M's. Mind discipline, emotional control, method analysis, decision-making, and money risk management, capital protection.
Yeah, the core pillars, according to Dr. Elder. We started this talking about the lure of freedom, that trading dream, but we also talked about the discipline, the costs, the psychological hurdles.
So here's a thought to leave you with. Thinking about the true costs in your daily life, not just money, but time, stress, emotional energy, those hidden expenses. What if you applied the kind of disciplined, mindful approach we discussed today, not just to trading, but to other areas of your life? Could that unlock a different kind of liberation, a different kind of freedom for you?